Rising inflation is having an impact on Bank of Canada's decision to cut interest rates further, and this is impacting the real estate market. Stay tuned to understand the intricate balance Bank of Canada needs to maintain and the implications on our economy. Welcome back to our channel, Get Samir Get Sold, where we talk about real estate in Oakville. The rate cuts are not happening fast enough, and inflation has a major role to play in this. We will go through 4 segments to understand what is happening, so watch till the end of the video to get the whole picture. Segment 1, recent interest rate cut. The Bank of Canada recently cut the interest rate by a quarter point to stimulate the economy by encouraging more borrowing and spending. When rates are low, loans become cheaper, boosting consumer and business spending, which helps the economy, especially during downturns. However, this strategy has its challenges. One major concern is rising inflation. Inflation is the rate at which prices for goods and services increase, reducing purchasing power. Rapid inflation means money doesn't go as far, impacting consumers' daily expenses. Higher inflation can erode the real value of savings, making it harder for people to plan future goals like buying a home or education for their kids. While low interest rates encourage spending, they can lead to higher inflation, affecting everyone's purchasing power. This creates a dilemma for the Bank of Canada. They need to keep rates low to grow the economy, but must also control inflation. Balancing these factors is crucial, and the bank must monitor this closely to avoid inflation spiraling out of control. Additionally, global factors like trade tensions and geopolitical uncertainties add complexity to the bank's decision, which influences inflation rate and overall growth. The Bank of Canada's rate cut aims to stimulate growth, but brings the challenge of managing inflation. It's a delicate balance, and we'll see how these policies play out in the coming months. Segment 2, role of inflation. So what exactly is inflation and why is it so important? Well, inflation is that rate at which the prices of goods and services rise, which decreases our purchasing power. If inflation is high, each dollar buys less. Over time, the value of money decreases and things cost more. Moderate inflation is a sign of a healthy economy, indicating people are spending, businesses are thriving, and there's a balance between supply and demand. However, uncontrolled inflation can lead to serious problems. It erodes purchasing power, affecting day-to-day living and the standard of living, especially for those on fixed incomes. Inflation also reduces the value of money over time. If the rate of savings is less than the rate of inflation, then the value of savings also diminishes. For example, if your savings earn 2% interest, but inflation is 3%, you're losing purchasing power. Higher borrowing costs are another consequence. Lenders demand higher interest rates to compensate for decreased purchasing power, making loans more expensive and potentially slowing economic growth. For the Bank of Canada, controlling inflation is a top priority. It adjusts interest rates to keep inflation within a target range. If inflation rises too quickly, the bank might increase rates to cool the economy, making borrowing more expensive and saving more attractive. However, raising rates too aggressively can stifle growth, reducing spending and investment. Inflation is influenced by various factors like consumer demand, supply chain disruptions, and global events. High demand can lead businesses to raise prices, while supply chain issues limit goods availability, driving prices up. Global events such as trade tensions also contribute to inflation. While moderate inflation is healthy, uncontrolled inflation can erode purchasing power and increase borrowing costs. The Bank of Canada's role in managing inflation is crucial for economic stability. We will have to see how the Bank of Canada manages the rate cuts, as most Canadians have been suffering for almost 18 months now. For the Bank of Canada, this is surely a double-edged sword. Segment 3, the balancing act. The Bank of Canada faces a delicate balancing act. On one hand, it needs to keep the interest rates low to stimulate economic growth. Lower rates make borrowing cheaper, encouraging consumers and businesses to spend and invest, which helps drive economic recovery. This increased activity boosts demand, leading to job creation and higher economic output. However, keeping interest rates low for too long can lead to higher inflation. When the economy overheats with increased demand but insufficient supply, prices rise, eroding purchasing power. This impacts everything from groceries to housing, making life more expensive for everyone. Preventing high inflation is as important as stimulating economic growth. High inflation can create economic uncertainty, making it difficult for businesses to plan and for consumers to budget. If people expect prices to keep rising, they might rush to buy goods now, driving up demand and prices further. Bank of Canada must find the right balance between stimulating economic growth and controlling inflation. This dual mandate involves promoting maximum employment while maintaining price stability. If rates are cut too aggressively, inflation can rise, reducing real incomes and dampening consumer spending. Higher inflation can also lead to increased borrowing costs over time. Conversely, raising rates too quickly can stifle growth. Higher borrowing costs can dampen consumer spending and business investment, potentially leading to slower growth or a recession. For instance, higher mortgage rates can cool down the housing market, reducing home sales and construction. The bank's decision-making involves analyzing various economic indicators. These indicators are GDP growth, unemployment rates, consumer spending, business investment, and inflation. It also monitors global conditions like trade policies and commodity prices. Effective communication of its policy intentions helps manage market expectations and behavior. The bank's task of balancing growth and inflation is a complex task. Missteps can have significant consequences for household budgets, business investments, and overall economic stability. Segment 4. Factors contributing to rising inflation. There are several factors driving the current rise of inflation. The one major factor is increase in consumer demand. As the economy recovers, people start spending more and businesses raise prices in response. This demand can come from higher disposable incomes, increased employment, or government stimulus packages. Supply chain disruptions also play a major role. The COVID-19 pandemic exposed vulnerabilities in global supply chains, leading to factory shutdowns and transportation bottlenecks. Even as economies reopen, these issues persist, causing higher costs for businesses, which are passed on to consumers. Global events also influence inflation. Trade tensions and geopolitical uncertainties can lead to disruption in the flow of goods and increase the cost for businesses. For example, conflicts or instability in key regions can affect the supply of essential commodities like oil, driving prices up. Changes in commodity prices directly impact inflation. Fluctuations in oil prices influence transportation and production costs across industries, leading to higher consumer prices. Similarly, increases in raw material prices drive up production costs, reflected in consumer prices. Labor market dynamics contribute to inflation as well. Low unemployment rates can lead businesses to offer higher wages to attract workers, increasing production costs, and consequently, prices. Monetary and fiscal policies also influence inflation. Loose monetary policies and expansive fiscal measures can boost demand, driving up prices. Inflation expectations can lead to a self-fulfilling prophecy. If businesses and consumers expect prices to rise, they may act in ways that contribute to inflation, like preemptively raising prices or accelerating purchases. Inflation is driven by a complex interplay of factors. These factors include consumer demand, supply chain disruptions, global events, commodity prices, labor market dynamics, monetary and fiscal policies, and inflation expectations. Understanding these factors is crucial for policymakers like the Bank of Canada. Segment 5, the dilemma of the Bank of Canada. So the Bank of Canada is truly caught between a rock and a hard place. On one hand, it needs to cut interest rates to stimulate growth. On the other hand, if it does it too aggressively, it can lead to higher inflation. This dilemma makes the central bank's decision-making process incredibly challenging, as it must navigate a complex economic landscape with multiple, often conflicting factors at play. First, let's delve into why the Bank of Canada might cut interest rates. Cutting interest rates is the most basic tool to stimulate economic growth. When interest rates are low, borrowing costs decrease for both consumers and businesses. This encourages spending and investment, which can help lift the economy, especially during periods of economic slowdown or recession. Consumers might take out more affordable loans for homes, cars, and other major purchases, while businesses might invest in new projects, expansion, and hiring, all of which contribute to economic growth. However, this strategy is also not without risks. If the Bank of Canada cuts rates too aggressively, that can lead to higher inflation. Inflation, as we've discussed, is the rate at which prices for goods and services increase. When interest rates are low, more money is in circulation as borrowing becomes cheaper and more attractive. This increased money supply can lead to higher demand for goods and services. If this demand outstrips supply, prices start to rise, leading to inflation. Inflation can be extremely problematic if it gets out of control. High inflation erodes purchasing power, meaning a dollar buys less than it did before. This can impact consumers' ability to afford everyday necessities, from groceries to housing. For those on fixed incomes, such as retirees, the impact can be even more severe as their income does not increase with rising prices. Additionally, high inflation can create uncertainty in the economy, making it difficult for businesses to plan for the future and for consumers to budget their expenses. So how do we summarize all this? Well, just like the Bank of Canada, every buyer who's thinking about the real estate market is also doing a balancing act. You see, a quarter-point rate cut doesn't do much on $1 million payment. So the balancing act that most buyers are doing at the moment is they're thinking, well, maybe I will wait for a couple more rate cuts for the monthly payment to come down, which makes sense, right? A quarter point doesn't do much on $1 million mortgage. Maybe you need a whole point for really a significant change in the payment. So just like Bank of Canada is taking risks by not lowering the interest rate costs, which might stifle economic growth, so are you as a buyer. You are not the only buyer who's waiting in the market for future rate cuts. But you see, when there are future rate cuts, yes, the monthly payments will come down, but also will more buyers enter the market? Because everybody is waiting. It's not that all of a sudden there are no buyers in Canada, or there are no buyers in the GTA, or there are no buyers in Oakville. Yes, they are. They're all playing the same game you are, which is the waiting game, the balancing act. Interest rate drops, and I can afford the home. But if you can only afford the home when you can buy it at a right price. You have to remember one thing. Interest rates will change, but the price you pay for your home, that's not going to change. That's going to be a constant. You buy a home today for $1 million. 20 years later, when you check, oh, what did I buy that home in 2024? That's going to be $1 million. However, 20 years later, when you see, oh, what was the interest rate I paid at that time? That's not going to be a constant. Now, how all this plays out, we'll just have to wait and see. So if you found this video informative, please like this video, click that bell icon, subscribe to our channel. Thank you for watching. You take care, and I'll see you in the next video.